Good morning, and thanks so much for tuning in. Happy Friday to you. My name is Alex Mathew, and you're watching All You Need to Know. Like the name suggests, we try to tell you everything that you need to know before the start of trade. Let's start with the headlines. U.S. equities continue to slide for a third straight day. All benchmarks set to break their 9-week winning streak. Bond yields rise across the curve, with the 10-year now close to 4%. Asian markets start mixed, with investors wary ahead of important jobs data in the U.S. this evening. Draft power tariff regulations propose higher return on equity on new storage-based projects. NTPC, Adani Power, among others, to benefit. Grasim Industries sets price for its 4,000 crore rupee rights issue at over 12% discount to the current market price. Promoters to bring in 1,200 crore rupees at the very least. Kumar Mangalam Birla says capex from private sector is picking up, says that the government spending on public infra is welcomed. Now, U.S. equities declined overnight, with them losing ground for a third straight day, and all benchmark indices are set to snap their 9-week winning streak. Risk assets have remained on the back foot for a little while as bond yields have continued to rise in the U.S., and they did rise once again sharply overnight. Traders have reduced expectations for interest rate cuts at major central banks this year after the latest data has pointed to greater resilience among major global economies. U.S. Treasuries fallen across the curve, with 10-year yields, or rather have risen across the curve yields, with the 10-year yield up as much as 8 basis points to about 4%. For context, about a week back, they were trading at less than 3.8%. The latest data that caused the shift in expectations was that U.S. companies increased hiring in December and wage gains continued to ease. Private payrolls have increased by 164,000 last month, and that's the most since August, according to the latest figures from the ADP Research Institute. Investor attention will now turn to the government's monthly jobs report that is due on Friday. Now, to put some of this into context and to tell you what to expect going forward, I'm joined by Geoffrey, who is independent emerging markets commentator. Jeff, thanks so much for taking the time this morning. Help us understand why we're seeing such a sharp rise in bond yields, and we've seen that over a couple of sessions. We're now at 4%, whereas a week ago we were at 3.8%. Seemingly, the bets of very aggressive rate cuts are being pulled back.
I think that latter point is absolutely one of the keys here. I think there's two things going on here. First of all, we had such a strong fourth quarter, and especially a very, very strong December, that I think there's just some natural profit taking as you go into the new year, investors being a little bit more cautious. But if you want a real factor, I think you put it down to the fact that the FOMC minutes really tried to make the point that the Fed was not particularly thinking about rate cuts at this stage. So the minutes turned out to be much, much more bearish, or somewhat more bearish than Chair Powell was in his press conference following the December meeting. At the same time, one of the regional governors also argued that they may even have to raise rates again. So I think what that's done is push the market's views of rate cuts out to perhaps the second half of the year. I've said the second half of the year for quite some time is more likely. And I think that's contributed to this sort of risk-off situation where bond yields have gone up, albeit they're still way down from where they were just a few weeks ago, and also a sharp move higher in the dollar so far this year. It's all classic sort of risk-off, and I think you put it down to those two factors. Okay.
Now, ordinarily, the jobs data or the information on jobs that we got overnight from the U.S. would have led to a little bit of a bullish sentiment, but that hasn't really played out. I'm just trying to understand. We're looking at a structural move, obviously, over the course of the next year and a half, perhaps, with interest rates expected to come down. So this, would you say, is a classic speed bump in the road? And, you know, structurally, we're going down for bond yields and up for equities over a period of time, assuming, of course, that soft landing does take place.
Yes, you're right. I think it's a speed bump. But I think it's worth pointing out that with the size of the US trade deficit, and in particular the size of the US budget deficit and the level of debt in the US, I think it's wrong to assume that bond yields will go that much lower. I suspect bond yields for 10 years will probably go to 3.5%, maybe by the spring or the early summer, but I don't think they're going to go much lower than that. And therefore, some of this good news has already come through. So I am constructive on equities this year. I'm particularly constructive on emerging markets, but I'm constructive on equities generally. But I don't think we're going to have as good a year as last year because the drivers here, the macro drivers, will not be as helpful. They will be helpful, but not as helpful as they were in 2023. And of course, we're sitting, certainly in the US anyway, at very, very high valuations. Now, on the jobs numbers, I wouldn't worry too much about I don't think the market should worry too much also about the ADP figures. The payroll numbers today, or today your time, are going to be much, much more important. And I think that's going to give us a better idea on whether the softening of the labor market that we've seen recently is continuing and what the outlook is for wages. So we're in a situation right now where bad news is good news. So if we got a softer labor market report, especially on the wage inflation front, the markets would like that because it would potentially bring earlier Fed rate cuts into play.
Last very quick question. Jeff, when do you expect the rate cuts to actually pan out? What are your own expectations?
I think it's going to be sometime around the middle of the year. Now, we do know that the Fed is talking about 3 rate cuts this year. The market seems to want more, at least it did want more. I think it's a question of interest rates staying higher for longer. And if we do get rate cuts this year, which I think we will, they'll probably all be in the second half. Maybe we get one in June, but it's going to be around mid-year with the first one, and then potentially a couple more later in the year.
Yes, all right. Thank you so much, Jeff, for joining us this morning and giving us that perspective. All right, let's shift focus to the Indian equity markets now and talk about the F&O cues. Agam is joining in to tell you just that. Morning, Agam. What are you picking up?
Good morning, Alex. So yesterday we were expecting weakness, but that didn't come through. And in fact, we saw strength on the benchmarks with advances coming through. So it was a mixed sort of a day, at least when it comes to the broader markets. The Nifty futures did see unwinding, even as the index advanced by around 7.7%. And as far as the Bank Nifty futures is concerned, that is also where we did see strength. Let's pull up the Bank Nifty futures, and that should be up for you on your screen as well. That's where we saw an up move around 1% with an increase in open interest towards 2.4%. When it comes to the options market, as we move into a new week, we are keeping an eye on a 500-point range once again, and we once again shift focus to the 22,000 mark, where we do have max OI around the calls, and of course the 21,500 put is where we are seeing the max OI inputs. That's the 500-point range that we are expected to see the Nifty to move within. Now, in terms of what happened yesterday, we saw the Nifty move higher, but along with that, we also started to see a lot more writing around higher levels in terms of calls, and some unwinding of puts around the 21,800 and 21,900 marks. Talk about stocks and what's really happened there. It was a mixed day of trade, long seen in Alchem Labs and India Cement. On the other hand, shorts building up in LTIM, Navin Fluorine and Escorts. And in terms of stocks, we saw unwinding, that is squaring off for positions. We saw longs unwinding in Lupin, but short covering for ONGC, Nalco, GMR Airports, and Federal Bank. Alex, we're towards the end of the week, a week which has been relatively volatile. Well, I reckon that positions today will be taken to be seen as to where we are going to be going ahead as far as this upcoming week's concerned.
All right. Thanks so much, Agam, for bringing us those details. Let's focus in on a group of stocks that is going to be likely very active in trade today, and those are the power stocks. The Central Electricity Regulatory Commission, in its draft tariff norms for the next 5 years, has raised the return on equity for new storage-based hydro projects, but more importantly, it has kept the ROE unchanged for thermal power projects. Vikas is here to tell you why that is important and to tell you everything that you need to know before the start of trade today. Vikas, important update coming in for the power sector as a whole. Can you break that down for us?
Yeah, right, Alex. As you rightly said, it has been increased. The ROE has been increased for pumped hydro projects and storage-based hydro projects to 17%, which is a jump from 16.5% earlier for the previous regulation. As far as thermal power projects are concerned, for existing as well as for new projects that will be commissioned after April 1, the time when the regulation will get effective, has remained unchanged at 15.5%. But for transmission projects, it has been reduced to 15% from 15.5%, especially for new projects which will be commissioned after April 1. Now, this kind of shows the intent of the government that they want to continue with thermal power projects as well as they are transitioning to, say, cleaner fuel-based power generation, where storage-based hydro projects is also one of them, apart from renewables. So, why it's important is because most of these companies were expecting that there would be a reduction in the ROE for thermal power projects, especially because now the focus is shifting towards greener projects, and also ROEs is a fixed cost towards tariff determination. So if you bring down the ROE, the tariffs would also come down, and which would be beneficial for the customers like you and me. So that hasn't happened. So that kind of shows that government plans to continue with these kind of projects for coming years, especially up till 2030 when new 80 gigawatt of additional power projects are expected to come up on the thermal side. There's going to be very beneficial for companies like NTPC, which is India's largest thermal power producer. They're also shifting into renewables with focus on pumped hydro. Companies like Tata Power, Adani Power, JSW Energy, NHPC, which is big time into hydropower and pumped hydropower generation. So these companies are expected to benefit in coming days, because of these.
Absolutely. Thanks so much for bringing us those details. A group of stocks that has gained quite significantly in the recent past and will likely be in focus today as well. Let's talk about Grasim. The update that came in last evening has to do with the price for its 4,000 crore rights issue. And to tell you more about that and to tell you what the context is and what the funds will be used for, I'm joined by Mahima. Mahima, what can you tell us about the price and why the company is using these funds?
Right, Alex, as you rightly mentioned, Grasim's right issue is to take place and the record date is set at 10th of January. The ratio for this right issue will be for every 179 shares, 6 shares will be issued, and the price is set at 1812 per share, which is at a discount of 12.47% as per the last closing price, that is yesterday's trading price. Now, how will this be paid? The first 25% of this share price will be paid on application, then first call will be for another 25%, then followed by 25% for second and third call each. Now, this needs to be completed by March of 26th, and these right shares will, of course, be traded on the exchanges. If we talk about promoters held 42.75% stake as of September, and the promoters are set to deploy 1,710 crore in this particular right issue. The total right issue stands as 4,000 crore, as you rightly mentioned. The proceeds from the right issue will basically be used for their capex expansions and repaying their debt. At present, their debt in the balance sheet stands at around 8,000 crores. If we also talk about a brief about how Grasim's capex program is taking place, they have Birla Opus, which is a 10,000 crore paint business, and they've also set up a 1 gigawatt plant in Aditya Birla Renewable, and there is one more Birla Pivot Tiles business, which is a new venture. So all these capex expansion plans is where the proceeds from right issues will be used.
All right, thanks so much, Mahima. Now, we will be talking about Grasim in a lot more detail in just a bit. It's on the editor's cut, and that's during the Market Open show. So do stay tuned for that. We have to slip into a very quick break. There's more stock-specific action on the other side, so do stay tuned. Welcome back. You're watching All You Need to Know. Let's focus in on stocks that are likely to be buzzing in trade today. And among them, there are updates in the defense space. We've got Anushi joining in to tell you about some of those and perhaps more stocks as well. Anushi, what do you have for us today?
Morning, Alex.
Morning.
Quite a lot of stocks on the list for today. So I'll start off with the Ministry of Defence, which has come out with order worth rupees 802 crores with BML and Jupiter Wagons. So coming to Jupiter Wagons, they have secured orders worth rupees 473 crores to build bogie open military wagons for the army units. While coming to BML, it has secured another order for rupees 329 crore. Just to go back, H1 FY24, the order book stood at rupees 12,743 crores. So quite, and we have seen in the Q3, they have reported quite some strong orders in this category. Now, now the third one in our list is Lupin, which has received a tentative US FDA approval for its Tapa glycofloxacin and saxagliptin tablets. These are used for the type 2 diabetes with an estimated annual sales of about $5 million in the US. The production for this is going to take place in the Pithampur facility in India. Along with this, now we have PFC, which has increased its FY24 borrowing plan to rupees 1.05 lakh crore compared to the 80,000 crore it had planned earlier. Do remember that PFC is one of the strongest gainers of the 2023, with the company also reporting a loan growth of about 19% and disbursement of 154% growth. Along with this, there was this Amphi reject also, wherein PFC is among the 9 stocks that has been moved from the mid-cap to large-cap category for the mutual funds. Now, just a reminder today that Nestle is going X-split today with the ratio of stock split of 1:10. This is the first ever stock split for the company. Just while we are on the stock split, the last stock for today is Vori Renewable Technologies, wherein the board is considering a stock split on Jan 20th for this. This stock again has risen by more than 300% in this past 1 year itself. So these are the stocks you should be watching out for today.
All right, thanks Anushi for giving us those details. Now, India is on its way to becoming a developed economy, is the word coming in from Aditya Birla Group's Kumar Mangalam Birla. He adds that the government is setting up infrastructure and doing all the right things to make this happen. Listen in.
I also believe that the government is doing all the right things, whether it's building infrastructure, digital properties that are public-facing, to make this happen.
So India has already seen with the government putting in so much money into capex. What kind of expectation do you have from the private sector now to play into this?
So I think capex from the private sector is also picking up on different fronts. And I think that along with government spend on public infrastructure is potentially a very potent combination. Thank you.
All right, we'll also talk about Grasim, as I mentioned, on the editor's cut. Do stay tuned for that. For now, let's turn to other stocks you want to watch out for in trade. And there are several companies that are reporting quarterly updates for the quarter gone by ahead of the earnings season. And Harsh is joining in to tell you about some of those. Harsh, what do you have on your list today?
Well, yes, Alex, good morning. Quickly on to some financials. Actually, that's what I'll be covering over the next couple of minutes. L&T Finance, very strong loan growth. AUM has grown by 31% year over year in Q3. You also had retail disbursements, which were up 25% year over year at 14,500 crore on a 1 lakh crore book, roughly. That's quite a large number, impressive number coming in. Portfolio retailization now has reached 91% is what they've suggested. Also, L&T Finance has done a quick fundraise, 500 crore with regard to NCDs is what they've approved. Quickly moving on to Utkarsh Small Finance Bank, that one, gross loan portfolio up 31% year over year. Mind you, newly listed as well. Total deposits up 18% year over year. And the CASA ratio has shrunk just about by 1% versus the year ago period. RBL Bank advances up 20% year over year, deposits up 13%. Again, you can see the difference between growth of advances and deposits. LDR seems to continue to increase and CASA ratio continues to shrink. J&K Bank up 14% year over year in terms of loan growth, deposit growth at 9%. That's the one for J&K Bank, slightly weakish. Loan growth also below what the market has done, and deposit growth also slightly below what the market has done for J&K Bank. All of those will be in focus.
All right, thanks so much, Harsh, for bringing us those details. Let's shift focus now to the FMCG space. And Dabur India has estimated that its revenue in the October to December quarter will grow to in mid to high single digits. We've got Sesha joining in to tell you more about what exactly the company is saying and why it's expecting that range of growth. Sesha, what can you tell us?
Dabur India has come up with its Q3 business update. Now, it has said that it expects the revenue growth to be in the mid to high single digit. Now, this is against the backdrop of the persistent weakness in rural demand, as well as price-led benefits have continued to fade. Now, growth in rural demand is still lagging urban growth, according to the company. However, it is still seeing early signs of revival in consumption. Now, cost-saving initiatives, easing inflation, as well as strong international performance help the firm forecast a bigger gross margin expansion. Segment-wise, food and beverages is estimated to grow in high single digit. Home care and personal care division is expected to grow in mid single digit, and the healthcare business is expected to grow in low to mid single digit due to the delay in the onset of winter season. However, in terms of the margins, the operating profit is likely to grow slightly ahead of the revenue post growth, as well as post growth in the year-on-year terms.
All right, an update on, thanks so much, Sesha, for bringing us those details. An update in the manufacturing space. The Ministry of Commerce and Industry is presently not considering a new production-linked incentive scheme to boost domestic manufacturing of toys. Instead, the ministry's focus is on ensuring that the existing plans, or PLIs, in various sectors are well implemented. We've got Janani joining in to tell us more about that decision. Janani, why did they decide not to go ahead with this?
Good morning, Alex. One of the primary reasons for this was to actually take a review of all the existing PLI schemes and see whether they have been well utilized. Now, this comes at the back of, when there will be whether new PLI schemes could be introduced. Now, remember, toys, e-bikes, and even footwear were some of the ones that were considered that could be, the new PLI schemes. As per the review last year, there was expected to be a lot of savings. And it was said that, from the existing outlay of 1.97 lakh crore, new schemes could also emerge and they'll be funded within the existing PLI outlay. But right now, the Commerce Ministry has told us that the PLI scheme for toys is not on the annual right now. And it is also said that, in fact, the toys industry is doing very well. It has seen a revival or a growth due to, governmental support, such as, increasing the basic custom duty, quality control measures, and other governmental support. So what we're getting to hear right now is perhaps the government just wants to do a review. Yesterday, the DPIIT secretary further added that for the white goods PLI, which is for air conditioners and LEDs, a third-party review will be undertaken, and they will actually check if, the beneficiaries are getting the intended benefits out of this, and if there are any roadblocks in the particular scheme, and if that, in fact, needs any course correction. So the thought process right now is to check whether all is running smoothly, if there are any chinks, in the armor, if the scheme is going well. Right. As far as latest data goes, we know that a 95,000 crore worth investment has come in as of September through this scheme.
All right. Thanks so much, Janani, for bringing us those details. And that brings us to the end of this edition of All You Need to Know. India Market Open is up next, so do stay tuned.